Hi, it's Matt Samuel with Fortress Financial. Here to talk to you today about the financial industry and more specifically financial advisors and how they work because it's pretty confusing for people. If you build up wealth, generally the process in Canada is you start off in banks. You do mutual funds, you do different types of investments, then you get to a certain size and people say, oh, you probably need a financial advisor now. Well, I was in the system for a long time. I was one of the top individuals in it. I had a great deal of success, and I say that with humility, but I worked incredibly hard to learn about markets, incredibly hard because I cared greatly about my customers and the people I dealt with. To me, that's what it was about. And I was a senior officer with firms. I wanted to see the firms grow, etc. I came to the conclusion in the end that, wow, this whole thing is based on one thing. And I guess I was a little naive. It's just about firm profitability, and which firm profitability leads to investment advisor profitability. So let's talk about it. You're all of a sudden told that, yeah, here's an investment advisor. He's known as being one of the best in the countries. What does that mean? Well, simply speaking, it doesn't at all mean that they're the best money managers or the best at giving returns to their customers, providing high quality returns. What it means is they have been the best at generating the highest revenues or commissions. That's how people are assessed in the industry. There's a ladder of success that basically says if you're at the top, that means you're the number one producer. People would say, wow, I'm dealing with the number one person. Well, all that means is that you're dealing with a person who has more fees and commissions over the year and made more money than anyone else because they get a good chunk of that, a lot of times upwards of 50+%. Not necessarily bad, but think about it. If they're generating huge commissions, they better have a huge book. If they don't have a huge book, that means their turn or the percentage charged on average per customer is significant. That's not good. We preach that you have to be in a low-fee environment because if you're not, your long-term performance is going to be dramatically impacted. If they're too big, reality is they can't manage all those accounts. It's impossible. They may have a team, but a team's irrelevant. So the chances are they're preaching buy and hold, and that's a failed proposition, especially if we're in the kind of environments we're in today. So there's been a huge movement in the industry. So anyways, the message there is be cautious when you're talking about the best producer. What you want is you should want someone with a high level of integrity, extreme knowledge, and very cognizant that the customer always has to be number one. Not easy to find in an industry that's very much driven by personal profitability. The other problem is if an advisor ends up making a lot of money, let's say they get to the point of making $500,000 plus a year. They're doing well. Successful life. What usually goes with a successful life? High costs of living. They live in an expensive home with a big mortgage and nice cars and kids in private school, etc., etc. So their lifestyle's oriented towards high cash flow. What happens when things get really ugly in the markets? And in theory, they should be pulling everyone out, saying, you shouldn't be in this game right now. The risks are way too high. Their revenues will dramatically go down as well as the firms. The firms won't want them to do it. They won't want to do it because it's going to impact their lifestyle dramatically. It's not going to happen. I actually did it in the late 90s when I saw a tech crash coming. I moved $250 million out of aggressive areas into very conservative areas because I was a huge believer that something big and ugly is coming, and it did. Markets crashed 50% in the early 2000s. But boy, did I recognize that I could be the one in the industry who everyone looked up to one who everyone was shaking their head saying, what happened to the guy? It's a shame. Something's really... And all that happened was I made sure my moral compass guided my decisions, not my financial pockets. So I realized at that point, this is not the right place to be for me personally. So this is where Fortress comes in. We teach people all these concepts. Remember, there's tons of hidden fees. If you're buying an insurance policy and its whole life, there's huge fees attached to it. If you're buying annuities, also monster fees that you're never disclosed. These things are negotiable and flexible, so you got to know what you're paying and at least know how you can negotiate it down. On fixed income products, there's hidden spreads, so you maybe should get let's say in today's world, more like 2.5% on a long-term bond, you might be offered 2.3, and you'd say, well, what's the big deal about that? Well, that might have translated into a $5,000 hidden commission that's out of your pocket. That's just outright wrong. Will this change? I hope so. There's talk about all fees being disclosed, and they should be, and it'll dramatically impact the industry. But you got to understand today what's going on before this happens, because advisors will more and more try and figure out ways to strip out as much as they can of your wealth. Am I saying they're all awful people? No, but they're driven by the attainment of higher and higher wealth. The way to do it is through your money. It's that simple. They don't get bonus by being good performers, by giving their account holders a 15% return versus the index was up 10. Nobody really cares about that. They care about what were your revenues. And that's good. It would say that's good simply because the clients are going to stay with you, and you're going to get more and more leverage probably from it. But their most important thing is to get more and more customers, because they want to put you in a fixed fee. And they're not going to make any more from you by managing, but they will make more by getting new people on board. So their main role is to gather assets, get new customers, put it on board, collect a fee, and keep doing that. And then when things get ugly, hold your hand and say, be in there for the long term. Mistake. It's a failing proposition that doesn't work. Keep your fees low. Sure, you have market timing tools, have risk management tools at your disposal, and you take charge of your investment advisor relationship. That's the only way you're going to win like you should. Thanks very much, and we'll talk to you soon.